Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
It's time for some calm. Joining us now, the 79th Secretary of the Treasury, Bessent. Mr. Secretary, welcome to the programme, sir. Let's pick up on that theme. Not you calming the markets, but on inflation and where rates should be. As Anne-Marie pointed out, we've had a string of softer than expected inflation reads in this country. We've had 4, we might get 5 at 8:30 Eastern time. Why do you believe that's signal and not noise?
Well, I mean, there's some persistence there, Jonathan. And look, I do have access to the number the night before, but when I'm coming on TV, I don't look at it. So I don't know what the number is going to be at 8:30. And I wouldn't, I don't know whether it's going to be down, up, or flat, but I wouldn't put too much emphasis on one number. I think it's the trend, and I think one thing that Wall Street, a lot of economists, market in general got wrong early on was that tariffs were going to cause a substantial price level rise, which just hasn't happened.
And there are some people on the FOMC, the Federal Reserve, still worried about the prospect of that happening through the summer. We've all sensed the frustration from the White House across the administration with Fed Chair Jay Powell. And a lot of confusion, I think, at this point that maybe we can address in this conversation. Is firing the Federal Reserve Chair under active consideration in the White House and the Treasury in your administration?
President Trump said numerous times he's not going to fire Jay Powell. He's working the refs, and I've said before, I'm a basketball fan. There are 2 schools of working the refs. There's the Bobby Knight School, and there's the Dean Smith School. President Trump seems to prefer the Bobby Knight School, and I'll tell you, I went back over the weekend and looked, and Bobby Knight won 3 NCAA championships. My hero, Dean Smith, only won 2.
The NEC director, Kevin Hassett, I'm not sure what you'd call him, but he was asked over the weekend, can the Fed chair be fired? He said that's a thing that's being looked into. How should we understand those comments?
Look, and I will point out, Kevin was a collegiate basketball player. And I think, as President Trump said, he's not looking to fire Chair Powell. And as I've said, I'm not going to comment on future policy or future mistakes the Fed will make. I'll only comment on past mistakes. And look, they've had some big forecasting errors, and this may be one now.
Is there a reason for not firing him? And I ask that question because the president's also said that his term is about to expire in May of next year. Is that the reason to ultimately just wait? Or is it something else? Are you convinced by the negative consequences associated with such a move?
Look, I think an independent central bank is very important for the conduct of monetary policy, and we can see that in terms of both the financial markets, the term premium, and longer-term debt.
You said previously the interview process would begin later on in the fall. There's been plenty of speculation as to whether that process would be brought forward. Mr. Secretary, do you still, as far as you understand, believe that's when the interview process to replace the Fed chair will begin in the fall, or has a formal process already started?
Well, look, there's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
Do you see any merit at all in selecting maybe a candidate that's already on the committee on the FOMC versus taking a look at someone outside of the Federal Reserve?
Again, there are a lot of good candidates inside and outside the Federal Reserve, Jonathan.
Has the chairman himself, the Fed Chair Jay Powell, given you any indication whatsoever as to what he would do once his term has expired? Will he vacate his seat as the governor of the Federal Reserve?
Well, traditionally, the Fed chair also steps down as a governor, and there's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. And I can tell you, I think it'd be very confusing for the market for a former Fed chair to stay on also.
Mr. Treasury Secretary, I'd love to talk to you about what's going on in NVIDIA this morning. Jensen Huang, the CEO, out in a blog statement saying that the company has, quote, provided an update to customers, noting that NVIDIA is filing applications to sell the H20 GPU again. The U.S. government has assured the company that licenses will be granted, and NVIDIA hopes to start deliveries soon. Can you attest whether or not that's true or not? The United States is willing to let NVIDIA sell H20s once again in China?
Well, again, Anne-Marie, I think that'd be a judgment that the Chinese indigenous manufacturers, namely Huawei and some others, already have an equivalent chip. So, if there's an equivalent chip, then the NVIDIA H20 could be sold, because I can tell you the one thing that we do not want is a digital Belt and Road springing up around the world, because other countries or China are substituting for our American chip manufacturers.
This is the same chip, though, that the Trump administration blocked with export controls in April. So why the change in policy now?
Anne-Marie, you might say that that was a negotiating chip that we used in Geneva and in London.
So this was part of the trade talks when it comes to Washington and Beijing?
Yes.
Was it a quid pro quo then? As you said, it wasn't, but was it potentially to make sure that you can get the licenses when it comes to rare earths?
Yeah, I think it was all part of a mosaic. They had things we wanted, we had things they wanted, and we're in a very good place. I expect to meet my Chinese counterpart, the vice premier, in the next few weeks.
So when and where will that meeting take place?
We're still working on that. The Chinese leadership has a big conclave at the beginning of August, so we're trying to work out whether that could be in a third country before or after that conclave.
Will the administration release the framework of the Geneva and London talks?
Well, we have released some of it, and I'll tell you that now, having settled on tariffs, on the export controls, we can move on to the next stage of talks. And I think it's very important, both for the global economy, for the U.S. economy, and for the Chinese economy, for us to move on and talk about China opening its markets and the increased domestic and consumer production there.
Are you hoping to get to that next phase before August 12th, when that's currently the détente between these two economies?
Yeah, I think we're in a very good place, and I tell market participants not to worry about August 12th.
Should they worry about what's happening with Europe with respect to the 30% tariff rate? They don't seem to be worrying, but I'm just curious whether that's the final rate or whether the letter was part of a negotiation that Europe received from President Trump.
Well, Lisa, what I would say is President Trump's able to create a lot of leverage here, because he's indifferent. He's indifferent whether we take in the 30% rate or whether the Europeans come to us with a much better deal. As I've been saying for a while, that if countries or trading blocs don't come with their best deals, then the rates could boomerang back. So President Trump's leading this, and what I will tell you is that a lot of the deals, and this is where his leadership's been invaluable, a lot of the deals that I thought were excellent deals keep getting improved upon every time he takes up the maximum pressure strategy.
There is a theory in markets, and you don't even have to calm them. They're pretty calm. They're watching all of these rates, and they're not freaking out in parlance on Wall Street. They're taking this in stride. We're close to all-time highs, if not at all-time highs. Do you see this as giving a green light to Trump, to President Trump, to keep going, to take hardline approaches, and to keep trying to get better and better deals?
Look, I think this narrative of this obsessive focus on the market isn't right. President Trump views this as a generational opportunity to reset trade in a fair and sound manner for the American people. So the idea that some market ups or downs are going to be the deciding factor here is what we are concerned about, and President Trump is laser focused on, is getting the best deals, because we were not having fair trade, and now we're seeing with these countries coming to the table, the quality of the deals gets better and better. So we're not going to rush just because of some market deadline. Now, I think what the market's seeing is market's willing to look forward 3, 6, 12 months, and this is going to be good for the U.S., it's going to be good for the global economy.
If you do get some sort of signal from the market, though, that this isn't going to be good for the U.S. economy, is there a trigger point? Is there sort of a sense at which it acts as a gut check and sort of pulls back some of the negotiating tactics?
Look, I think the market understands what we're doing. Sometimes individual market people don't. Sometimes the television personalities don't. But good thing about President Trump is he always tells you what he wants, and what he wants is fair trade here.
I won't take that as a slight on me and my colleagues around the table, Mr. Treasury Secretary, but you did tell me on April 2nd, on Liberation Day, that this was the ceiling when it comes to those rates. But since then, we have actually had some tariff rates the president announced in letters higher than those rates he announced on that big chart on April 2nd. So is there no longer a ceiling when it comes to tariff rates when you are dealing with trading partners?
I think that I said if they come and they negotiate in good faith, then those are ceilings. And some of the talks got off to very slow starts.
So who's negotiating in good faith at this moment and who's not?
Again, I congratulated the UK the other day, as I told many of our trading partners, and Anne-Marie, I may have said on that day or a few days after April 2nd, I'd advise countries to move quickly, because with President Trump, the first deals are usually the best deals. And the UK came in early. They got a great deal. And everybody else is kind of dragging right now. Well,
when it comes to Japan, you're headed there at the end of this week. Do you expect to come back with a deal?
I'm going to Japan to represent the United States government and the American people at the International Expo, which we used to know as the World's Fair. So this coming Saturday is going to be America's Day, and I'll be taking a delegation, includes the Labor Secretary, Deputy Secretary of State, will be representing the U.S. So this is a celebration of the U.S. more than trade talks.
Mr. Secretary, before you go, just a final question. I'm embarrassed to say that my knowledge of college basketball is nothing like yours, but I can tell you back in the 90s in English football, there used to be a concept of player managers. There used to be certain managers of football teams that also put themselves on the field, and they played too. Effectively, they had two jobs. And I'm wondering from your perspective whether that's something you'd be interested in. We've seen that throughout the administration. Is that something you think that you could pursue, both the Treasury Secretary and the Fed chair?
Look, I think I have the best job in town. I will do what President Trump wants. We got a lot of great Fed candidates, and I'm confident it's going to be a robust process, Jonathan.
Has he asked you?
What's that?
Has he asked you? Are you part of the process?
I am part of the decision-making process, but again, it's the final decision is going to be President Trump's.
Mr. Secretary, appreciate your time. Thank you. The Treasury Secretary there, Scott Bessent, on a range of issues, including trade and the future of this Federal Reserve. Inflation data due at 8:30 Eastern Time. About an hour away. Joining us now is Sarah Hunt of Alpine Saxon Woods. Sarah, good morning.
Good morning.
Is inflation dead?
I think it's quiet at the moment, but I wouldn't completely rule it out. I think that there's some possibilities that it could pick its head up, but I think that it's hard for people to anticipate data when we spend a whole lot of time anticipating a bunch of stuff that didn't happen. So I think there's a little bit of fatigue there, so it's hard to say right now.
It's difficult to forecast. There's still some debate over the data we've already had. What's underpinning these softer than expected reads, and why won't it last?
So if we think about whether or not companies did a huge pull of inventory forward and or people started changing their behavior because they knew what was coming, you could argue why that's soft now and why it should rise if the rates are going higher. But you still see these moving of the goalposts in terms of timing, which allows companies to bring inventories back in again and refresh that. So I could see a lot of bumpiness in the data, and I also think that companies have had a lot of time to prepare for this. And if I'm sitting there, I want my margins to stay where they are, so I'm going to try to do whatever substituting I can. So I also think that there's probably a lack of understanding how much of that substitution has gone on, and I think that that is why it could be bumpier and less dramatically higher than people are expecting, because they're expecting a really fast move.
I just wonder, can we expect immaculate disinflation, ongoing immaculate disinflation where there is no pain in the overall economy at the same time that inflation is dead? Does that seem consistent with you, or is there kind of a tension right now between employment data that's pretty okay, albeit with very slow activity, and inflation that seems to be, maybe if not dead, in hospice?
It is one of those periods of time where figuring out what that data means is going to be tricky. It remains tricky. Earnings are going to matter for the stock market. Inflation is going to matter to some degree, but only if it's really surprising or gets much higher than people are looking for. And then investors really start to worry. The question is, what do those trends look like? I mean, to Treasury Secretary Bessent's point, it's not just about one number. It's about where the trend is going. If it looks like the trend is reversing, investors are going to like that a whole lot less.
Do you just not pay attention to the data at all and buy AI? Buy NVIDIA and just, call it a day?
It would have been the good trade for this year, right? I mean, that's sort of what happened, is that you had all this concern about AI going into the beginning of the year. Then you had the trade situation. Everybody started looking at every single earnings call from Microsoft or every hyperscaler to parse exactly what their spending was going to be. There was this little bit of freak out, and then everybody got over it really quickly. So that would have been that reversal. And that goes back to the idea that the companies that have growth and the companies that generate a ton of cash and have good margins are the places that they end up performing better than the rest of the market anyway.
It would have been good to get in on NVIDIA just last night, given the fact that they have a blog post out saying that those H20 chips that this administration blocked are now going to be able to go to China. How do you deal with this basically flip-flop almost within weeks or months of this administration when you're trying to direct what to do in a portfolio?
Well, I mean, flip-flop is an interesting term. I think it's more about, again, to Treasury Bessent's point, it's changing those dynamics may have been part of that discussion all along. So you have to assume that some of the things that are coming out as X or Y, maybe X or Y under certain circumstances, but if I change my mind, they're going to be different. So that's got to be, and I don't think that that's entirely different from things that the way the world works anyway. But I think that certainly in the near term, this administration has been much different about market changes than other administrations.
It's not just NVIDIA, it's AMD just resuming shipments to China once their license clears. That stock is up in the pre-market as well.
Look, China's a big business for all of these chip providers. And the key question is, can they understand the rules of the game enough to create chips that are compliant with some of the constraints that have been put on them from the U.S. government?
Sarah, it's good to see you. Sarah Hunt of Alpine Saxon Woods. I want to bring in Neil Dutta of Renaissance Macro. Neil, welcome to the program, sir. That's not 4, it's 5. Why is that signal and not noise?
Well, I think, look, obviously tariff revenues are going up, right? And the effective tariff rate is rising. That was the case in June. And despite that, inflation missed expectations. So that means that, tariffs increase costs. We all know that. Who ends up bearing the cost is where the debate is. And, I think at the margin, this probably reflects more of a margin squeeze than anything else. It's not like prices for core goods aren't going up. They are. But you have, I was just looking at the data. You see big increases in appliances. You see big increases in all sorts of household furnishing and supplies. But it's also important to remember that service sector inflation, service sector prices represents the lion's share of what people spend their money on, and prices in those areas continue to go down. Ultimately, it's going to come down to nominal dollars spent. Right. So to the extent that people shift more of their household budgets towards goods because the prices of those things are going up, they'll have less left over to spend elsewhere. And that means that services are at risk. And that's why they'll ultimately see the prices for those things coming down. So that to me seems to be what's going on. The nominal anchor isn't changing. Tariffs are resulting in a relative price shift. That's pushing up the prices for consumer goods. That is clear. If you look at the data, that's obvious. Look at household furnishings in the latest report. But services are providing an important offset.
Neil, is that a good enough reason for two Fed governors on the FOMC later on this month to stick their hand up and say, I think we should cut rates?
I mean, I don't think they'll be as noisy about it in July, only because, the last employment report gave them some calm, right, because the unemployment rate went down. But, ultimately, for me, it's about, what is nominal income doing? When you take like the sum product of jobs, hours, and earnings, and you look at it over the last several months, it doesn't look particularly encouraging. At the same time, you've seen the work week decline, particularly in the areas that are seeing the most robust jobs growth, like education and health. Right. So if you start to see jobs in those areas slow down, what's left? I still continue to have concerns about the job market over the summer, but that just reinforces this weakness in nominal income that we've seen. So ultimately, it all comes down to the household budget constraint. And to the extent that prices are rising in one area, that means that quantity is going to go down in other areas.
So Neil, just to sort of sum up what you've been talking about, I think it's really interesting that you see these numbers as not representing strength in the economy, but a sign of weakness in places like services that is bringing down the overall inflation rate that otherwise is getting inflated by certain goods prices going up, like home appliances. At what point is that weakness necessary to keep inflation low? In other words, not necessarily a reason for the Fed to cut, but to hold where they are so that you can have that offset in a way that doesn't allow inflation to really kick back up.
I mean, I don't think one rate cut's really going to change that in any material way. I mean, the Fed policy is still restrictive. That means they can start and they'd still be restrictive. They don't have to promise a broad swath of rate cuts. In fact, they're not doing that. So, I don't think a rate cut in July or even one in September is going to materially, change that dynamic.
If you are just joining us, welcome to the program. Equities high here. The opening bell about 54 minutes away. Moments ago, inflation data in the United States, month over month, headline CPI up from 0.1% the previous month to 0.3%, in line with expectations. But for core CPI, it's another downside surprise, 0.2% against an expectation of 0.3%. It's 5 consecutive months of softer than expected core CPI. Mike McKee's back with us for more. Mike, you've had a second look. What jumps out to you?
Well, I think Neil pointed out the major tariff implications here. We do see a 0.4% rise in apparel overall and a significant rise in footwear, up 0.7%, male footwear in particular. Now, those things come from China. Other things coming from China that go up or from other Asian countries. Furniture, as he mentioned, was up 0.4%. Household furnishings up 1%. And appliances up 1.9%. They were up 0.8% last month. A lot of this probably has to do with the tariffs on steel. We saw that when we had the steel tariffs in the first Trump administration, that appliance prices went up. Food, 0.3%, still in line. President added extra tariffs on tomatoes yesterday, but in June they were down 1.5%. And I know Anne-Marie is anxious to know that eggs were down 7.4%. One other thing that comes in for the China aspect of it is toy prices up 1.8%. So we are seeing some tariff pass-through here. But again, I would look at what Neil was saying about service prices. They were relatively restrained, up 0.3%. We saw medical care and auto insurance prices very tame this month. So some of the things that we had seen pushing up inflation in the services categories have backed off for a while at least.
Mike McKee, thank you, sir. Equities higher in response to some of this. We're up by 0.4% on the S&P. Yields a little bit lower across the bond market. The yield curve looks like this. 10-year yields this morning down by 2 basis points. Similar move on a 30. So you don't see the tariff inflation on a headline, but you start to see it just a little bit beneath the surface.
And you start to see what the response function is of households, that they might be cutting back maybe on eating out to compensate for the increased costs elsewhere, which you wonder on a compositional level whether this tamps down overall inflation, even as you see pockets of higher prices in select areas. Is that the path of travel, or is that just the current state of affairs as people take stock of exactly what the new scenario is?
We can have that discussion right now with David Kelly of JPMorgan Asset Management. David, welcome to the program, sir. How much comfort can you take from this morning's inflation data?
And not a lot. It's a very interesting report because you can see sort of the fading of issues that were causing inflation over the last few years. But you can also see the beginnings of the inflation problem related to tariffs. So if you look at owner's equivalent rent, auto insurance, those are the things that really held inflation up, and they're going away. And the other thing that really helped this report is we had a further decline in airline fares, a further decline in lodging prices. There's a lot of weakness in the tourism industry right now, and that's in this report. But when you look at core goods outside of new autos, we're seeing those goods prices go up, and that's where you're going to see this tariff inflation. And we have only seen the thin end of the wedge here. It takes a while for the tariffs to be implemented. It takes a while for the revenue to be collected. It takes a while for the inventory to make it to people's shelves. It takes a while for the retailers to say, look, I'm going to have to mark it up. But it is coming. So, I fully agree with the Fed's forecast that inflation is going to go up between now and the end of the year, and they've got to stay on their guard.
And yet, David, they also believe it starts to come back down again. In fact, for that reason, some officials, including Governor Waller, believes you can look through it. Do you think you can just look through it?
Not yet, because we also have a lot of fiscal sugar in the first half of next year. What's going to happen is that we had a lot of temporary tax breaks put in for 4 years, but they start at the start of this year. They're not going to adjust income tax withholding schedules quickly enough. That means a bumper season for refunds early next year. And we know from 2022 that you've got supply chain issues, and then you give consumers a lot of extra cash. What happens? You end up with inflation. Eventually I think it'll fade. In the long run, I am not an inflation hawk in America. I think inflation will fade, but I think it's going to be sustained by some of the provisions of the OBBBA. Because of that, I think the Fed needs to hold off here. If we got clarity on tariffs, if we could say this is what the tariffs rates are and they will go no higher, then I think that makes it easier for the Fed. So, I think the administration really needs to think about, look, could we please, whatever the tariff policy is, let's make it and be done with it, because this uncertainty is the very thing that's making it impossible for the Federal Reserve to say that we're out of the woods or will be out of the woods on inflation.
David, is there a sort of a necessary weakness that we need to see in consumer spending and services at this point to make sure that inflation doesn't take off? In other words, that pain that Neil was talking about that you can start seeing in the data on the margins.
Well, that's a tough way to do it. The way you want to, if you're worried about a long-term inflation problem, it's only going to come because wage growth sort of compensates for price increases. Now, we still have a relatively weak labor force in terms of their ability to demand wage increases. I think, again, we have to think a little bit about how immigration is affecting labor supply. And again, there's huge question marks there. But so long as we don't see an acceleration in wage growth, the inflation will fade. It's not just a matter of consumer spending being weak. So long as wage growth is controlled, inflation will fade again. But I think it's way too early to say that inflation's coming down to 2%. We've still got to get past tariffs. We've got to get past the stimulative effects of this fiscal bill, and that's really what's causing the delay in any further Fed easing.
Neil Dutta of Renmax still with us. Neil, today's about prices, Thursday's about spending. Let's talk about retail sales. How do you expect some of our understanding of prices this morning to show up in spending and retail sales later this week?
Well, if goods prices are rising and the consensus expects nominal retail sales to rise 0.3, that basically tells you that real spending on goods is declining. That's not exactly an encouraging situation. So, the fact that price increases are showing up and, it's more or less matching what you see in the retail sales data, that basically tells you that the volume of goods sold is going down. Look, it comes back to P times Q. Whatever goes into price is going to come out of quantity because the nominal anchor hasn't really changed. So, look, I think consumers are actually quite resistant to higher prices, with the exception of the University of Michigan data. If you look at, other estimates for inflation expectations, whether that's the New York Fed survey of consumer expectations, Atlanta Fed business inflation expectations, professional forecasters inflation expectations, it suggests that, people are resistant to higher prices, and they're acting as if you look at the areas where people have been cutting back their consumption, those are the areas where the prices have been going up the most. So it's not particularly surprising. And the labor markets remain still in a tricky spot. While the unemployment rate remains low, you still have, rising increase in, discouraged workers, people that are out of the workforce but want a job now. Companies are telling you, like the small businesses are saying that there's, poor sales are a bigger concern. So, I think that probably reinforces ongoing weakness in wage growth. And, that means that households don't really have the capacity to absorb higher prices. And
David,
that means that they have to cut back.
No, and it's a good point, Neil. And David, I guess that if you take what Neil is saying, the idea that you do see real price resistance by consumers, and if you do see this sort of compensating for the extra expense in goods by pulling back on services, what would the harm be for the Fed to cut rates by just 25 basis points or 50 basis points?
Well, any problems the economy is facing is not really about interest rates being too high. And I think we have to think carefully about long-term policies, about helping the labor force grow, about helping free enterprise and reduce regulation and reduce barriers to business. And I think we need to focus on that. I don't think the interest rates are too high right now. I think the Fed's the steward of the dollar and of our inflation outlook in the long run. And they've said they're committed to 2% inflation. I think they should stick to their guns. If the economy gets into trouble, it's not because they kept rates too high.
Neil, I just want to give you the final word just on housing, which is something you've been following now for months and months and months and flagging the weakness here. Why is that so important to you, Neil?
Well, because it undercuts the argument that was just made, which is that that interest rates are fine, right? Obviously, housing isn't weakening because of tariffs or anything else. Housing's weakening because rates are too high, and you're seeing, a rising pile of completed new unsold inventory. That hasn't been as high. That's been rising, over the last year or so, and that's starting to weigh on home prices, which we see. So, I think that the housing market does provide some evidence that interest rates are restraining economic activity.
Is that the Fed's fault, or is that the fault of Congress, Neil?
No, but the reason we're seeing that, the reason we've got trouble in the housing market is not because rates are too high now. It's because rates were way too low for way too long after the great financial crisis, causing prices to jack up to a level that cannot be supported at normal mortgage rates. There's nothing wrong with mortgage rates. The problem is home prices, which are too high because rates were too low for too long.
Well, mortgage rates are running 6.5% to 7%, and wage growth is rising just 3%. So I think the math is actually getting quite challenging for most people. That's why housing's not working.
Well, it's challenging, but only because home prices are the anomaly here. They're just too high because rates were too low for too long.
I'm sitting back now, gents. I thought you'd continue. Neil Dutta of Renmac, David Kelly at JPMorgan. To the two of you, appreciate it. Thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.